Hey guys, what's going on? Roke Investor here, back to make another video. Today I'm kind of trying to talk about and focus on just the wheel strategy. And basically it'll be a beginner video, how to understand how to utilize the wheel strategy, which is a strategy as far as options trading is concerned. It's one of the safer strategies as far as options goes. And honestly, if you ask me, it's very easy to follow. So that's why I figured I try to make like a wheel strategy for beginners, which is, this is basically it. So I drew up some information on the chart behind me. Hopefully you guys can see it. If not, you can hear me, I'm sure. So anyway, when it comes to the wheel strategy, obviously it's a part of options, so it's just the way of utilizing options trading. When you think of options, these are contracts between a buyer and a seller. So if you're utilizing the wheel strategy, you're the seller only, you're not the buyer. When you're the buyer, you're more so betting on a stock to go up or fail, and you're putting in a small premium amount in hopes of that. And if it doesn't go your way, you could lose the premium, and that's the downside. As the seller, you're the one getting the premium. So you're the one posting the collateral for these shares, whether or not you own them or not. So as the seller, you're basically making the income. The buyer is playing maybe the get rich quicker scheme, but the seller is more so the get rich slow, which I don't know about you guys, but I like to play it safer and have less of a chance of losing my money, and I also like consistent income. So along with my dividend income, I also, in creating a strategy, which is the wheel strategy, or similar to it at least, which is options income. And I'm doing this on a weekly basis. So I figured I'd just go through an example so you guys can kind of understand what the wheel strategy is. So I drew up a wheel here, which we'll get to it towards the end, but it basically describes what you're doing with the wheel strategy. So you're going from selling a put to selling a call, to selling a put to selling a call, and around and around you go. And all the while, what are you doing? You're collecting premium. Yes, there are risks, and those risks, are the same risks you have doing dividend investing, which is a company could tank, and you're stuck in that company. But similar to dividend investing, when you utilize a wheel strategy, you want to pick stocks that you trust, stocks that will, are safe, stocks that you think will be around, stocks that cannot be interrupted. Obviously, you cannot predict where the price of the stock is going. If you could do that, you'd be rich. But you have an idea, you have an estimated guess. So that's, basically what is behind this. So first off, like I said, before you even do anything in options, you need to think about what stocks you want to do contracts with. So you want to, if you own nothing right now, if you haven't even started, you're going to start with selling puts. Now, when you sell a put, what that means is you're willing to buy 100 shares. Each contract is 100 shares, by the way. It means you're willing to commit money to buy 100 shares at this price by this date. So you need to be able to pick a stock that you know and love and you think will be around forever and ever and ever, whatever. And you need to pick a price that you think is fair. Obviously, when you're selling a put, you're going to pick a price under the current stock price. And you're going to pick a date. And then in return, you get paid a premium, and you get that right away. Okay? So that's selling a put. Now, let's just talk about a company. So I wrote down ticker symbol CWH, which stands for Camping World Holdings. Is this a safe company? Maybe in your eyes it is. Maybe in your eyes it isn't. To me, it's more so, it's not necessarily a long-term dividend stock. When I think of long-term dividend stock, I think of Procter and Gamble. I think of, Walmart, companies like that, United Healthcare. But there's also going to be companies that are not necessarily a long-term dividend investment plan, but there's companies that I don't mind owning for the short to long term, and that's CWH. This is a company that Marcus Lemonis owns. I don't know if you guys watch The Profit, but I love the guy Marcus Lemonis. That's not why I like CWH, but obviously I looked them up and everything, and they're doing well. They're the leader in their industry, so it's just a company that I trust, and it just happens to be volatile. And when it comes to getting paid a premium, the biggest thing that matters, the biggest thing that affects the premium is implied volatility, or AKA IV. So if you look up a contract and the implied volatility is, say, above 50%, you're probably going to get a decent premium. But if you go to Target or Procter and Gamble, typically the implied volatility will be in the 20 to 30%. So you'll still get a premium, just not a lot. But again, that's up to you, to decide. The higher the premium, keep in mind the higher risk. If it's very volatile, that means people are buying and selling all the time, all kinds of prices. So you got your hands full with this one. So yeah, this one's volatile. Why is it volatile? Honestly, I don't know. Maybe it has to do with COVID and people are camping now, so it doesn't make sense to me. So anyway, in the example of CWH, their current stock price is $31.75. Now, one thing I always do, I look at the highs and the lows for 1 year, 6 months, but I especially look at the 3-month high-low. Because obviously, especially now, you look up the 1 year low, it's the freaking COVID low. You can't count that. That's BS. So if I look out 3 months, I feel a little better, okay? 3 months, the lowest was 25.69. So that's pretty low, as compared to that. Not too bad. And then the high was 41.85. So, it's good range, not too crazy. So if the current stock price is $31.75, and I want to start the wheel strategy, I want to sell a put, what do I do? Well, for starters, there's two choices here, really. You can be really brave, and you can say that I love this stock so much, I think it's worth $32.50. So I'm going to sell a put with an expiration date of March 12th, which, as of today, it's 8 days away. And they'll pay me $1.70 per share. So again, keep in mind, each contract is 100 shares. So you'll get $170 up front for committing to buying Camping World at $32.50 by this date, 8 days away. Now, the premium is exceptionally high here because your strike price is above the current price. So, keeping in mind, if the stock market or if expiration was today, you're definitely going to get assigned. You're going to get assigned 100 shares at $32.50, which is above the current stock price of $31.75. So, obviously, if today was expiration date, you would not sign up for a $32.50 because you're already losing money. You're already losing 75 cents per share on that transaction. So, normally, when you're going to sell a put, you're going to typically pick a strike price that's below or close to the money, typically below. And I'll go through an example where I did not. I recently did one where I chose in the money. This is called in the money when it's at the price or above. So, again, if you look at Camping World, let's just look at the lowest one, okay? And you can go as low as you want for strike price. So, but if it's eventually going to get to a point, say like you go to $25, your put premium will be 0. So what the hell, or it'll be a penny. I think the lowest it goes is a penny. So if you do a penny, what do you get? $1. No thanks. I'll pass on that one. So anyway, if you look at this, strike price $31. If I sell a put at $31, 8 days away, I get $110 per share, aka $110 up front. So is it worth getting $110 to commit to buying 100 shares of this stock price at $31? If you look at the highs and the lows, what do you think? Is this a fair value? You have to determine, is this a good price for the stock? And am I okay owning the price at $31? That needs to be, you need to make certain of that. So once you sell the put for $31, the 110 per share, aka $110, will go right into your account. Obviously, once the contract is sold. It's called, by the way, you're going to sell a put to open. People write SPO. You'll see that online. Sell put to open, $31, expiration 3/12, 110 premium. So $110 is yours. Now all you do is wait. So if by March 12th this stock is below $31, if it's $30.95, then you're likely going to get assigned, and you're going to have to buy these shares at $31. So again, that should be okay for you. And if it is, great. And then you get the 100 shares. By the way, I don't think I mentioned this, collateral. Before you can put through a transaction, you need to have the collateral. So when you're looking at the strike prices, you need to have the collateral of this amount times 100. So if we did do the 31 strike, you need $3,100 up front. You need that cash in your account, because as soon as you sell that put, it's going to pull that money from your account. It's going to hold it, because again, you need to be good for the money. It's going to hold that money, because if you get assigned, that money's gone and you get the shares. But if the expiration goes over 31, if the stock price ends up at the same price on expiration, you get your collateral back into the account. Meanwhile, regardless of the end result, you're still keeping $110. So that's the options income that we're really talking about. This is why we're doing it. We're doing it for the premium. All the while, we're doing it on stocks we love. So again, if it happened to, again, we're selling a put, it's part of the wheel. So if it happened to get assigned, then you now own 100 shares at $31. So what happens now? Well, now you're in the wheel. You're part of the wheel. So you still want to collect premium. So the next step is selling a call. So let's say the stock price, let's say, Monday morning, it opens, somehow it's back up to $31.75. You're sitting pretty. You're sitting on some capital gains here. Possible capital gains. But let's say the stock recovers and it's at that. You could have similar premiums. Because again, I have put premiums here and I have call premiums here. So I'm trying to give an example, in the similar situation. So let's say Monday morning, okay, the stock recovers. It's at $31.75 again. You're sitting in a good position. You own 100 shares at $31. You want to sell a call. So when you sell a call, you can either try to just sell at the strike, which means your break even, your capital gain is a break even, or you can try to get some capital gains and sell at a higher strike. Obviously, if the stock tanked, you may need to sell at even a lower strike, but you're going to lose on capital gains. So you have to keep that in mind as comparison to the premium you received, because you don't want to lose money on the transaction. It's not worth it. So what me myself, I always look for a strike price. It has to be at least equal to what I own the shares at. So, if the stock tumbled to 25, I don't care. I'm probably going to still sell a call at $31. That premium may not be attractive, but it's just temporary. I know the stock will recover, again, because these are stocks. These are companies that you love and own. You love to, you don't mind owning. You think they're, positive companies. But you may be in a rut for a while, and so be it. Your premium's just going to be a little lower. But obviously in this situation, you're doing good. So the current stock price is $31.75. You own 100 shares at $31. So now you can sell a call. These are the call premiums per amount. So let's say, all right, I want to sell a little higher. So I'm going to sell at $32. I'm going to sell a call at $32, which in this same scenario, 8 days away, at that price, you would get $1.63 in premium. Now, again, that's $163 for committing. In this example, you're not posting collateral, you're posting your shares. You're committing to selling your shares at $32 no matter what happens. So if it comes to expiration and the stock price is above $32, if it's $40, you're selling at 32. So that's, on the flip side, again, we talked about the buyers in the beginning. That's why they're doing it. So if someone's going to buy your options contract and pay you $163 because they think the stock will be $40 by expiration, possibly, or even more. That's why they're doing it. They want to take advantage. They look at it as, okay, I'm putting up only $163, but the end goal, the end amount of money that I can make is endless. You're limited on what you can make. And right here, you're only no matter what happens, you're making 25 cents a share in capital gains plus $1.63 in premium. That's it. That's the most you can make. However, you should be okay with that because we're just making steady income, right? Steady income on the wheel. Again, we're selling a call. Now, again, if it expires and the stock price is above your strike, they're going to be sold. The buyer gets the stock, or whoever gets the stock. The money maker, the buyer, an actual person, who the hell knows. Someone on the other side got the stock. So now you have the money back in your account. Before you posted 3,100 collateral, now you have 3,200 in your account. So you made some capital gains right there. Not too bad. And you made some premium. You made the 110 here, the 163 there. And this is over again. These are weekly options, weekly income. So you can make the income, whether it be through, the premium, the capital gains, and dividends, etc., which I'll get into in a second. So again, in this example, that's why they call it a wheel. You sold a put, and then you sold a call, and then you got your money back. So what are you going to do? You're going to sell another put. And if you get assigned, guess what? You're going to sell another call. And if that gets assigned, what do you do? That's why it's a rotation. So I'm just going to give a quick example of what I did the other day. I sold a put in the money. Again, in the money means I sold a put with a strike price above the current stock price. And the reason I did that is because, and I did it on Camping World, and I did it with an expiration of this Friday, which is 3/5, because their ex-dividend date is next week. And they're going to pay out a quarterly dividend and a special dividend. So, if I get assigned, I am okay with it. I'm okay with owning the company, and I'm certainly okay with getting a dividend. So if I get assigned, great. I'm getting 2 dividends, a quarterly and a special. And then what am I going to do? I'm going to sell calls. If I do not get assigned, good, fine, I'll sell another put. Again, the idea when you sell puts, you really don't want to be assigned most of the time. I mean, unless it's a dividend play, like I said, you really, because you want to have the leverage. You want to have the money to put wherever you want. Because what I do is I have a watch list. I sort it by, for the day, stocks that are down. The highest, who's down the most. If a stock, like this stock the other day was down 5% and I had the dividend play in mind, so I'm like, oh my God, it's a perfect opportunity. So that's why I sold in the money. I got a decent premium. It was like $100 and it was for 4 days. So if I get assigned, good. I'm going to, collect some dividends. And then after X dividend date, I will sell the calls. Because if you sell the call before X dividend date, then they may take assignment early. You don't know. So I'm going to keep it until the X dividend date. And then on X dividend date, I'm going to sell calls. That was my plan, at least, with the dividend play. Because I like to, keep most of my watch list dividend stocks. There are others, obviously. You can't just restrict it to that. Because there are good companies that don't pay dividends that you may want to sell options on. So, all right, now I have the wheel here, and then I have important terms. So I wanted to cover these important terms. And again, I went through most of it, so this will probably be quick. Hope you guys are enjoying the video so far. Strike prices, obviously we went through that. That's basically the biggest thing here. That's the price you're committing to. When you sell a put, you're committing to buying at this price. When you sell a call, you're committing to selling at that price. So the strike price is very important. Expiration dates, again, very important. This, me myself, I like weekly puts. I don't want to be stuck in a long 1 month thing. So I choose stocks typically that have weekly expirations. Not every stock does. And the stocks that don't typically, are not that volatile. So it's not attractive to a lot of buyers to do it on a weekly basis. So a lot of the boring stocks, the boring safe stocks, are monthly expiration, which is fine. But I like to look for weekly. I like to make this a weekly thing. Don't get me wrong, I am in some monthly too. I do a weekly and monthly. I try to get a variation. But also, the further expiration you go, the higher the premium in most cases. So yeah, the expiration date is very important. Typically, the expiration date will be the Friday. It'll always expire on a Friday. Unless the market's closed, I assume. I haven't run into that situation. Premiums, this is why we do it, right? This is why we're doing selling options. This is why we do the wheel strategy. This is our income. This is what we want. Someone on the buy side is willing to pay us. Great. So what we'll do is we'll put our money where our mouth is. Here, I'll commit $3,100. Here you go. If I get signed, I don't care. Fine. I'll take the stocks and then I'll sell a call. So that's premium. Dividends, again, I talked about dividends. They're very important. Wheel strategy works great for dividend stocks mainly because, say you sell a put, you get a sign, and the stock crashes. And selling calls at the strike price you bought is not attractive anymore. This 5 cents or 1 cent, you're not going to get rich off that. But you need to be okay with holding the stock. You need to be okay being stuck in the stock. So if you're stuck in the stock and they pay a quarterly dividend or even monthly, great. That makes you feel a little better being stuck because the idea is the stock will eventually recover, but there could be a down. A big down. It could be some terrible news that came out. Just the luck of the draw. You have terrible timing, and the stock just tanked. But you're in a stock that pays you a dividend, 3-4%. Awesome. I'm still getting a dividend. I'm doing this anyway. On the other side, I have a dividend investing account. I just hold it and collect the dividend. So I'm just holding it in this case, collect the dividend. I'll still sell calls, get a crappy premium because the stock's down. But as the stock comes up, I'm gonna keep selling the call at the strike. At least, I could sell for less. I can consider all the premium I made and consider that not a loss. Or I could just keep it at the strike and then be happy holding it, collecting the dividend. If it's not a dividend stock, then you're really just holding it, waiting, kind of stuck, which sucks. But it is what it is. Sometimes you might need to take a loss. I don't know. That's up to you. Next one, very important, implied volatility. Again, if you see 100% implied volatility, this stock is high risk. But with high risk is high reward, high premiums. But, you have to keep that in mind. And you're going to get, I'm stupid too. I got greedy. I got into a stock, SPCE, Virgin Galactic. I was selling puts every freaking week. Implied volatility, 100%, over 100%. Premiums, ching, ching, ching. All of a sudden, they push back their test flight. Stock down 10% almost every single day. What happens? I'm stuck in a put, 51 strike, current stock price $32. I got my hands full. So, which leads me into my next topic, rolling orders. What I can do now, which I'm still in, I've been rolling my order over. So I'm essentially doing a pushback of the date, pushing back expiration. So I'm buying to close the current position at a very high price, and I'm selling to open the following week. And the break, it's almost a break even. I made $5 last week making a rolling order. It's just not worth it. So I'm at a point where I'm stuck. I may need to buy a stock that is worth right now $32 and has a $51 strike price. So I'm going to already be down massively. Selling calls on this is going to suck for a while. But this is, it's one of those stocks, it's kind of like how Tesla was. It's a space stock, it's an attraction. They plan on just people paying hundreds of thousands of dollars to fly into space as an attraction. There's rich people that enjoy this. But the test flight has to work. It has to happen. It's going to happen in May, so hopefully the stock recovers then, and then I can move on my merry way. But I got greedy, So if something has high implied volatility and you don't want necessarily to get involved with high risk, just stay under 100, stay under 70 even. I mean, also, there's going to be high implied volatility if you're going to sell a put or call over earnings. So if earnings is happening in between, the implied volatility is going to be high because, you guys know after earnings the stock could fly up or, tank. Typically it tanks, even with good news sometimes. So they always say don't sell calls or puts over earnings, which honestly I don't necessarily agree with that, because you got to make money too. So you got to look at the earnings and what's the estimate, what do they expect it to make? How'd they do last time, last quarter, last year? I don't know, it's up to you guys. But anyway, last but not least, collateral. As I said, you need to have the money in your account to sell a put for the strike price. Again, strike price times 100 shares, you need to have that amount of money in your account. Of course, there's other ways like margin. You can apply for margin, which is essentially a loan through the brokerage, and you pay them interest on this loan. But I'm a Ramsey guy. I'm all about no debt. So therefore, if you start getting involved with margin, you're really, really talking about high risk, because you can really get screwed, get behind, and I would just, if you ask me, stay away. If you don't have the money to sell puts, sell calls, whatever, then don't do it. Just read up, learn. I started small. I could only afford forward freaking puts, and they were $8, so $800. Obviously, it's up to 12 now or so. So, but still, that's only $1,200. Most people, they could shell that. But forward does not have high implied volatility, so the premiums I was getting was kind of weak, and they also aren't paying a dividend right now, so double weak. But anyway, that's the wheel strategy. I kind of went over time here, which is fine as long as you guys are learning. I wanted to do the wheel strategy basics. So again, I'm the broke investor. I'm not a financial advisor. I'm just a guy learning as I go, and I'm trying to share it with you guys. So if you guys want to get involved with this, again, take my advice with a grain of salt. You can do your own research, do what you got to do, feel comfortable yourself. It's all about you and your risk tolerance. If you're going to do something, make sure you can handle it. So do not take high risks if you can't stomach it. But if you're a high risk kind of guy, then do it. Screw it. It's your money. You want to make the most with your money. So maybe, the risk is worth the reward. Anyway, guys, I hope you enjoyed this video. Please subscribe to my channel. I'm hoping to, make some more videos, but I need I need a reason to. I need the people to tell me why. Also, please click like if you enjoyed the video and leave a comment if you have questions or whatever. Alright guys, I'm out of here. Later.